Welcome back to the Daily Crypto Roundup. Today, we have a really important mix of stories because this is one of those days where the market itself looks fairly calm on the surface, but underneath it, the financial system is changing very quickly. Bitcoin is holding above $77,000. Oil has dropped sharply. Asian equities are moving higher. Nasdaq is pushing closer to launching Bitcoin options. The SEC has delayed part of its tokenized stock plan. And Coinbase CEO Brian Armstrong is saying very clearly that finance either moves on-chain or it gets left behind. So this is not just another normal crypto news day. This is a day where you can see two stories happening at the same time. On one side, traders are still watching Bitcoin's price, ETF flows, oil prices, moving averages, and whether risk appetite is coming back. But on the other side, institutions, regulators, exchanges, and major crypto companies are all trying to work out what the next version of the financial system actually looks like. And increasingly, that answer seems to involve Bitcoin, tokenized assets, stablecoins, and blockchain rails. And just before we continue, today's episode is brought to you by Kraken, our official crypto exchange partner. If you want a straightforward way to buy, sell, and explore crypto, Kraken is well worth a look. They have been around for years. They are one of the most recognized names in the industry. And if you want to check them out, you can use our link in the description. As always, this is not financial advice. Crypto involves risk, and you should only invest what you can afford to lose. Now let's start with Bitcoin, because the headline today is that Bitcoin is trading above $77,000 after a sharp fall in oil helped support sentiment across Asian markets. Oil dropped around 5%, and that matters because energy prices have been one of the biggest macro pressure points lately. When oil spikes, markets worry about inflation, central banks, consumer pressure, and geopolitical risk. When oil cools, even temporarily, investors tend to breathe a little easier. The reason oil pulled back is linked to hopes around the Strait of Hormuz and the possibility of progress toward reopening a major global energy choke point. That matters far beyond oil traders. If oil supply routes look more secure, inflation fears can ease. If inflation fears ease, risk assets can catch a bid. And Bitcoin, whether people like it or not, still trades partly like a macro risk asset in moments like this. That is why Bitcoin moving back above $77,000 is interesting. It is not a massive breakout yet, but it is a sign that buyers are still defending key levels. The important point is that Bitcoin is holding up better than some of the major altcoins. Ethereum, XRP, and Solana were also higher, but they were still lagging behind their own 50-day moving averages. In simple terms, Bitcoin is showing relative strength, while the altcoin market is still more fragile. But this is where we need to stay professional and not get carried away. There are still warning signs. Analysts are watching spot Bitcoin ETF flows very closely because there have been more than $2 billion of outflows over the last couple of weeks. That does not mean the bull market is over. It does not mean Bitcoin is about to collapse. But it does mean every rally has to prove itself. If ETF selling slows down, Bitcoin can stabilize. If ETF outflows keep coming, then every bounce becomes harder to hold. The other thing to watch is exchange flow data. One report pointed to more than 18,000 Bitcoin moving net into centralized exchanges, and that can sometimes suggest potential sell-side pressure. Again, that does not mean those coins are definitely being sold. But when coins move onto exchanges, traders pay attention because it can mean holders are preparing to take action. So, the honest read today is this. Bitcoin looks better than it did a few days ago. Macro sentiment has improved. Oil is helping, but this is not a clean all clear yet. Now the next story is a big one, because Bitcoin options are coming closer to Nasdaq. Nasdaq PHLX has received conditional approval from the SEC to list cash-settled European-style Bitcoin index options under the ticker QBTC, although the product still needs CFTC approval before it can properly launch. This might sound technical, but it is actually very important. These options would track the CMECF Bitcoin Real-Time Index, and they would settle in US dollars. That means investors would not receive actual Bitcoin at expiration. Instead, they would receive or pay the cash difference based on where the Bitcoin index ends up. The reason this matters is accessibility. At the moment, a lot of Bitcoin derivatives trading happens through specialist futures platforms or crypto-native venues. Nasdaq bringing Bitcoin index options onto a familiar exchange platform could make it easier for institutions, wealth managers, and even some retail investors to access Bitcoin risk management through accounts they already use. And the contract size is important as well. Each QBTC contract would represent exposure to 1 Bitcoin. That is much smaller than the standard CME Bitcoin options contract, which is tied to 5 Bitcoin. When Bitcoin is trading above $77,000, 5 Bitcoin is a huge notional amount. So a 1 Bitcoin contract gives smaller institutions and more sophisticated retail traders a more manageable way to hedge or trade volatility. In plain English, this means Bitcoin is becoming more like a normal asset inside the traditional financial system. First, it was spot ETFs, then institutional custody, then corporate treasuries. Now we are talking about Nasdaq-listed Bitcoin options. This is the kind of infrastructure that makes Bitcoin harder to dismiss. You do not build this kind of product around an asset that is disappearing. You build it around an asset that major market participants expect to be around for the long term. But there is a second side to this. Options can increase liquidity and help with hedging, but they can also increase volatility around major expiry dates. When more derivatives exist around Bitcoin, price action can become more complex. Market makers hedge positions. Traders target strike prices. Expiry dates become important. So this is bullish for institutional adoption, but it also means Bitcoin's market structure is getting more sophisticated. Now let's move to tokenized stocks, because the SEC has reportedly delayed a proposed exemption that would have helped shape tokenized stock trading. The reason for the delay is important. Exchanges and other market participants raised concerns about investor protections, ownership rights, and how blockchain-based shares would work in practice. This is exactly where the tokenization story gets real. Everyone loves the idea of putting stocks, bonds, funds, and real estate on-chain. Faster settlement, 24/7 trading, fractional ownership, global access. It all sounds brilliant. But when you are talking about tokenized stocks, you have to answer some difficult questions. Does the token actually represent legal ownership of the share? Does the holder get dividends? Does the holder get voting rights? Who verifies ownership if the tokens move around semi-pseudonymous blockchains? What stops an unauthorized firm from issuing stock-linked tokens that look like real company shares but are not properly backed? These are not small details. They are the difference between serious financial innovation and a complete mess. According to the report, Hester Pierce indicated that the proposed framework would likely support issuer-backed digital versions of publicly traded equities. That is the key phrase. Issuer-backed. In other words, if Apple shares are tokenized, the market needs to know the token is properly connected to real Apple equity, not just a synthetic product pretending to represent Apple. So the SEC delay is not necessarily anti-crypto. In fact, you could argue it is sensible. If tokenized stocks are going to become a serious part of the market, the rules need to be tight enough that investors understand exactly what they own. Rushing this could damage the entire sector. Getting it right could open up a massive new market. And that brings us neatly to Brian Armstrong's comments, because the Coinbase CEO has laid out 8 areas where he believes finance still needs a major upgrade. His list includes tokenization of real-world assets, 24/7 global trading, stablecoin payments, AI tools, self-custody wallets, easier capital formation, sound money, and better regulation. That is basically the Coinbase roadmap for the next financial system. Armstrong's argument is that finance should become more global, more automated, more open, and more on-chain. And whether you agree with every detail or not, the direction of travel is hard to ignore. Real-world asset tokenization is one of the biggest themes here. Stocks, bonds, funds, and real estate could eventually move onto blockchain rails, allowing faster settlement, fractional ownership, and broader distribution. Stablecoins are another major piece because they allow near-instant global transfers without relying on traditional banking hours. Then you add AI payments, where software agents can pay each other or buy services automatically using crypto rails. And suddenly the idea of finance being open Monday to Friday starts to feel outdated. This is why today's stories all connect. Bitcoin holding above $77,000 is the market story. Nasdaq Bitcoin options are the Wall Street adoption story. The SEC delaying tokenized stock rules is the regulation story. Brian Armstrong talking about on-chain finance is the long-term vision story. The conclusion for listeners is this: do not just watch the Bitcoin price. The price matters, of course it does. But the bigger signal is the infrastructure being built around crypto. Bitcoin options on Nasdaq, tokenized stock debates at the SEC, stablecoins passing hundreds of billions in market value, Coinbase building on-chain payment systems, and traditional finance trying to work out how to adapt. That is the real story. For now, Bitcoin needs to hold key levels, ETF outflows need to slow, and macro sentiment still depends heavily on oil, inflation, and geopolitical headlines. But zooming out, the direction is clear. Crypto is not sitting outside the financial system anymore. It is being pulled into the center of it. That does not mean every coin wins. It does not mean every tokenized asset is safe. It does not mean prices go straight up. But it does mean the rails of finance are changing. And the people who understand that early will have a much better chance of understanding where the next major opportunities come from. As always, this is not financial advice. Do your own research, manage your risk, and never blindly chase the market. But today's message is simple. Bitcoin is holding firm. Wall Street is building more access. Regulators are trying to work out tokenization, and Coinbase is pushing the idea that the future of finance is on-chain. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.